One of the biggest debates for retail investors is whether to make regular monthly contributions or lump sum investments as a way of mitigating risk. In a column for Finweek, Craig Gradidge looked at the different scenarios and came up with some interesting statistics. So we take a look at what works and what doesn't. Craig Gradidge, Director of Investments at Gradidge-Mahura Investments, and Shaun, who's a Director at Quaester Wealth Management, both joining us at the desk. Thanks for joining us. So Craig, I'll start off with you because of course you did some analysis on looking at what the difference is in terms of the overall returns you can get for monthly contributions versus a lump sum investment. Bottom line, take us through what you came up with.
Yes, it was actually an interesting bit of research. I had a client who specifically wanted the Gradidge Balance Fund, and she was investing on a monthly basis, and I asked her why. And she had looked at past performance, and the fund had performed very well. And so I went back and I did a bit of research and showed her some very interesting stuff, because on a monthly basis, yes, the Gradidge Balance Fund had done very well, yet another balance fund, and I just took the Coronation Balance Fund just for the sake of an argument and used that as a comparison. For lump sum investments, the Gradidge Fund had outperformed by about 30%. But when it came to a monthly investment, it had outperformed by only 1%. So quite a disparity in terms of the performance of a lump sum investment relative to a regular investment, even though the time periods and the funds that were used were the same. I extended that analysis and I looked at the Gradidge Balance versus the stock market versus the JSE. And a similar scenario unfolds as well. It outperforms the JSE quite significantly for a lump sum investment, yet for a monthly investment, the JSE outperformed the Gradidge Balance over the same period. And what that research showed was, those factors that investors fear the most, volatility and downward markets, are actually the things that help make a monthly investment work for you.
Okay, so Shaun, what are your views on kind of the findings that were here? I mean, do you agree with them that monthly contributions take out all that noise, all the volatility, and help you reap almost benefit from them?
Yeah, I think it's also relatively well documented, the principle of Rand cost averaging. I think that's very much what we're covering here today. And what one sees through that principle is that much of the volatility that you do see in the market does get smoothed out. So from an investor behavior point of view, and certainly from a return experience point of view, you can have that benefit.
Yeah, I mean, one of the questions I suppose I would ask is how much costs, and I know that it's always a sensitive subject when you look at the asset management industry, but I think it's fair to say that costs running on unit trusts, the generic unit trust product, have come down enough to make it worthwhile to put in monthly. You're not getting hit with this idea that it's actually coming to 2 or 3% of your contribution every month. You're now down to about 1%. How much does cost influence what you ultimately came out with?
Yeah, look, I think cost is a very important point, and it also goes to the issue of what type of investment product you choose. So your products that pay upfront fees to the advisors, I mean, we certainly do not favor those. The return to the investors significantly less than a straightforward unit trust or an ETF exchange, ETF for that matter. So, yeah, costs in general have been coming down, and we're seeing more and more of that. A bit of a price war going on at the moment, which benefits consumers.
Has that, so just very quick, has that been sparked by ETFs, passive investment options?
I think ETFs has been a catalyst, but also we're moving into a low return environment, a low inflation environment, so that's showing up costs a lot more, and you're dealing with a more aware investor and consumer.
I just have a question for you, Craig. When you look at the profile of an investor, say a first-time investor or an investor with a lower risk profile, perhaps just less funds available, would you recommend the monthly contribution model to that kind of investor? Does the profile of investor count when it comes to that?
Yes and no. It does. If the first thing is affordability. What can the investor afford to put away? And if they can't afford to do a lump sum, then a monthly is the next best thing. But the important thing is that a low risk investor with a lump sum actually gets a lower risk portfolio than a low risk investor that's putting on a monthly basis. Just recognizing the fact that volatility works for the investor.
What do you find that most first-time investors do? Are they more comfortable with the lumps, the monthly contribution, or do they just go for the lump sum? Have you seen a trend in first-time investors?
Yeah, there's no real data out there on lump sum versus monthly. I think when you see the big outflows, you generally see small continuous inflows, which suggests a certain level of monthly flows into the unit trust sector. But the majority, I mean, in our experience as a business is we have more clients on a monthly investment rather than on a lump sum investment.
Shaun, let's just take the discussion back to, for example, unit trust versus passive investment, in a sense, something that tracks the all-share index. And you said that the monthly contributions, you saw the unit trust outperforming an ETF type tracker. What are your thoughts on that then, what it says about the value of active management in a sense?
Yeah, I think it's going to come down to whatever track record you're going to look at. It's going to come down to what time period you're going to look at. So depending on what time periods we tested, whether it be 1, 3, 5, 10 years, 7, 8, 9, whatever the case may be, you'd probably have slightly different outcomes, and you'll have the all share, sort of winning on one hand and perhaps losing on the other. For me, the bigger question is around where and how you use passive investing as a tool in your portfolio, and I'm personally hugely in favour of that style of investing, and only getting into the active when you've got somebody who can deliver some deep value and a high concentration portfolio.
So maybe this is where the cynicism comes in with the asset management industry is you obviously have the market fallout 2008, 2009, and suddenly the successful funds don't look so great. Suddenly your returns are actually coming back to normal, but the way the asset management industry then responds is they go and they create new products at the bottom of the industry. And yes, I'm being a little bit cynical here, but you're creating new products at the bottom of the industry, at the bottom of a cycle. They deliver phenomenal 30-40% returns in a year, and suddenly they go out there and they be sold again as they become products that are sold, not bought. And I think that is where the cynicism around the active industry comes versus the passive. In terms, passive you kind of fire and forget. The active one, you're saying, well, these guys are supposed to be able to time the industry. And I just wonder, when you talk to clients, are they aware that often a lot of these products are being created post certain events in the industry and then being sold to them for the sake of historical one-year returns?
I think, like Craig intimated earlier, is the consumers and the investors out there are getting a lot more astute, and they're getting access to a lot more information and knowledge. So whether they've got to that degree yet, I'm not entirely sure, but certainly I think the time would be coming for that. To come back to what we're talking about in terms of the asset managers as well, is really that if one has a look at it, there will be active managers that will outperform. But the question is, how does one choose them in advance? And how do you know which one that is going to be outperforming in the years or decades to follow? And I think that's the trick, and that's the difficulty. What you often find is everyone sort of resorting to perhaps Allan Gray's Coronation Prudential, all great managers, but can they continue to outperform at the rate that they have been? That's the big question mark for me. For those that have such a strong value bias, can they continue to go and search and seek out that value with such a big wallet?
And not mentioning any names, but just looking at last year, there was one fund manager who was so committed to resources, and it really wiped out so much money and a huge track record. So that, that does happen, where fantastic fund managers make wrong decisions and people's money is kind of compromised.
Yeah, absolutely.
Yeah, Craig, you manage my finances, so it's always interesting to talk about investor psychology in a lot of ways. And when you look at the lump sum versus the monthly contribution, one of the things I've picked up just looking at myself anecdotally is that if you're doing the monthly thing, it becomes something that your budget can swallow. You get a 10 grand or 20 grand bonus in for Christmas in a lucky year, but it's spent before you know that. It becomes when you turn it into a habit, the habit becomes easier to. It's better to feed the habit than necessarily trying to time the market.
Sure. Look, I think it was Confucius that said that the journey of 1,000 miles begins with one step. And monthly investing is certainly one way in which the market opens up to a lot more, quite a big part of the population compared to lump sum investing, where you either get a pension payout or you win the lotto or some kind of, or somebody in the family dies and leaves you money. The important thing with monthly investing, though, is as you say, it becomes part of your budget. It becomes a habit, and over time you actually start looking past it. But if you consider just over the last 10 years, 1,000 rand put into the market, the average balance fund and to cash, that 1,000 rand is worth close on 300,000 in the market, 220 in a balance fund and 170 in the bank. And at the bottom of the financial crisis, they were worth 97, 96 and 95,000, with the bank investment being worth 95,000. So what it does allow you to do is take on investment risk. And this thing that investors fear the most, so it's a bit like investment karate, you take the force of the opponent and you use it against the opponent himself. So monthly investing allows you to do that, and quite spectacularly in certain instances.
How much can you start with? I mean, what's the minimum amount? If we're talking about someone who's new to the market, they're hearing this conversation and they want to start investing on a monthly basis.
Yeah, I can't say regular investing is what I deal with on an everyday basis, but from what I understand, the unit trust started about 500 rand a month, somewhere around there.
ETF 300. Some of the bigger mancos at about 100 a month for an equity fund.
Does it make sense to be picking up one here, one every month, if you could call it that? I mean, if you do only have 300 to 500 rand to be investing a month.
Yeah, if you've got a long-term period, you just invest in one until you can afford another, But that's the thing, is investors tend to create these obstacles to starting an investment. I can only afford one. I'll wait until I can afford two. Start.
But the way I see it, I think it's a great tool to start investing, to just make that break into the market. It's less intimidating. So for first-time investors, I think it's a great option just to get you on the road, as you said, taking the first step.
I mean, Shaun, what about looking at it from, one of the things I see as a retail investor is that it's too easy to take your money out again. You get into this habit, you put 300, and suddenly you've got 4 grand at the end of the year, and suddenly, oh cool, I'm going to go buy an Xbox or whatever it is. What about taking the lump sum contributions as something that you plug into an RA or something that you're not going to be able to touch? I mean, is that kind of a strategy that you can see sort of your higher net worth people doing, where they do get lump sums, they're dumping it into something that they're not necessarily going to try and grab the moment they have a cash flow issue?
Yeah, look, I think there is benefit in that, and certainly from a discipline point of view, one has to understand where you lie on that scale. For me, in those types of circumstances, I truly believe that's where a great financial planner can actually play a huge role for clients, where you can sit down and once you've designed an entire plan and see how all the pieces come together like a big puzzle, just psychologically you kind of go, well, I don't want to pull at anything in case it all falls apart. That's the first thing. The second thing is when you have that need, that desire, that whatever, to say I need some of that cash, you can sit down and say, that's fine. What is the consequence of that? And then sort of realize it from that perspective. And what I've certainly found is being able to go through that type of process with my clients has made them a lot more disciplined in some areas, but has also allowed them to spend more in other areas when they actually wanted to. So you get this proper balance of saying, well, what is actually realistic in terms of my finances and my future? What can I be spoiling myself on, and what should I perhaps be putting away for the long term?
Not everyone has access to a financial planner, though, and some people, I suppose, would like to do it and they don't get around to it. So I mean, this is perhaps moving into another space, but questions that need to be asked up front about, is it always about what is your income, what are your expenses? I mean, what are the typical ways you start a conversation with a new client?
With a new client? Yeah, absolutely. I mean, you're going to look at income and expenses, you're going to have a look at the balance sheets, so what are the assets, potential liabilities. Yeah, how are you going to fund those liabilities? Because we're talking about investing now, and sometimes the best investment you can make is to sort of cover off and sort out some of your debt. So those are the real issues that start to come into play, and it's really around bridging the gap, saying, where am I now? What have I got now? What don't I have now? Look at the time frames that we're planning for, and where you want to ultimately be. And there's a combination of factors that really come in. It comes into saying, well, firstly, how much I earn right now and how much can I save or should I be saving? The next is, how do I go about investing that money? When is it that I want to become financially independent, and how much do I want to spend or enjoy after that point? And depending on those 4 variables, there's a number of different permutations that could come out. And I think that's the key, is you're not going to find a one-size-fits-all strategy for everybody.
Maybe, Craig, you have your views on rules of thumb in terms of what rules don't really work. But I mean, what about working with something that said in your monthly portfolio you're going to do a monthly in your normal portfolio you're going to do monthly contributions into a balanced type fund. When you do get a lump sum in, say in December, go and stick it with a value manager or something that's got a slightly different risk profile to what you're doing in a general in your general financial planning. I mean, strategy like that maybe something to consider.
Yeah, look, with a lump sum investment, your biggest risk is timing risk. So I wouldn't have any kind of rules of thumb or investment strategy, kind of general strategy around that, because at the time when that lump sum becomes available for an investment, you've got to see how check out the lay of the land at that point and see what would be the best decision. I think a high-level strategy from our side would be to see which are the asset classes, or which we wouldn't really go into sectors, but which of the asset classes are hurting the most. So 2 or 3 years ago, we were giving clients a higher offshore exposure. And
people might argue you can still be using that strategy.
Well, at the moment, probably you're right. Offshore at the moment. A year ago, equities were looking a bit better. 3 or 4 years ago, property was delivering quite high yields. During the financial crisis, you could lock in a dividend yield from equity of over 6%. So at the point when those lump sums become available, you then able to say, well, what would add the best value at this point?
I think that's the one thing. And the other option is, if you have a lump sum and if you don't invest all at once, what other alternative you've got, which is really phasing in. And you can choose how long you want to go do that for. Interestingly enough, and we want to also look at rule of thumbs, is that the sort of undeniable evidence is that putting your lump sum all at once is going to provide a better outcome more often than actually putting into phasing. So a number of studies
that goes against what Craig's saying.
Sorry?
Doesn't that go against what Craig's saying?
No, it's not going. What we're saying in terms of the rand cost averaging is that's a natural benefit that's built in for the rand cost for the recurring investor. And what we're assuming from a recurring investor point of view is that's the option that they've got. So you don't necessarily have this massive amount to do it. So you're smoothing out a lot of that risk. But when you look at saying, do I phase in over 3, 6, 9 or 12 months versus putting a lump sum in, you're going to find that the lump sum is going to win more often than not. In fact, in terms of the 3 and 6 month variables, the answer is almost exactly the same. If you're going to phase in, 9 to 12 months becomes your only option. And what you see there is 63% of the time, lump sum is going to give you a better return.